Hello, Jim here. Today I've got two really good companies that I've been selling options on recently. I've been using the option wheel and doing quite well with it. I'm going to share with you both these companies, why I chose them, and then actually share some trades at the very end of the video. So stay tuned. I think you're really going to enjoy what I have for you. Let's go ahead and jump right in and get started. I typically like to do a quick market update. Not much has changed from last week. I still believe the Fed's going to do a couple rate cuts next year. They alluded to three. I still think it's going to be 2 to 3. Probably not starting till second quarter. I think we're going to have probably still a trending upwards market for the rest of the holidays and going into January. By the middle to end of January, all bets are off. I think we may actually get a bit of a correction, probably more like early February. Do I have anything to base that off of? The only thing I have really to base that off of is that the government's going to be negotiating the budget again. I believe that happens late January, early February, and I think it's going to get really controversial. That we can't keep these gigantic budgets. Will they do what needs to be done? That's the big question. We just we have so much national debt and so much interest it's paying on the national debt. So I think that could be a headwind. And I do think we may have a few other headwinds, like with what's going on in the Gulf. There may be, energy has been down a lot, and I think that's impacted inflation. I think energy is probably going to have a bounce back. The pricing of oil is probably going to go up some, and that may actually bring back some inflation. So I wouldn't be surprised if we have a bit of a downturn again, late January, early February, maybe going into March or something like that. At least that's my own 2 cents. And as always, it's probably only worth 2 cents. So let's jump right in. I'm going to try to keep this video a little bit shorter. But what's been so important for me to be successful as an option trader, and it's true of any trader, is picking the right companies. I typically pick companies I want to own. And I have three main criteria that I use when I pick them. First is, are they profitable? I don't typically trade in any companies that aren't making money. And then second, are they growing? Do they have some growth potential? Especially year over year earnings. Are they increasing those earnings in such a way that, maybe they're going to have a 30, 40, 50% increase in earnings in the next year or two, or just enough to do well enough to pay their debts or lower their debts. And again, that's my next big point, is low debt. I think a company with no debt is amazing. One of the ones I talk about today has no debt. But if they have low debt, then that's almost as good. It shows that they know how to work with debt. The other thing I like to look at, do they pay dividends? The two companies I'm going to talk about today do not pay dividends. They're more on the growth side. But I really like dividend companies that where they're actually growing the dividends. They're not just paying a high yield, but year over year they're continuously growing the dividends. That becomes very important. If they're able to grow dividends and they have low debt and they're profitable, those are good companies. It's funny, I find in a lot of cases, Wall Street will like some companies that aren't making money. And they'll actually shun companies that are making money and have no debt, like Zoom. They seem to constantly be, against Zoom or not liking Zoom. I also think that may be the case of the companies I'm talking about today. Now, what I like to do is run the wheel on these, and I call it the bargain wheel. So I'm not trying to invest in companies that are really expensive. They also need to be what I call bargains. So they have a PE that looks correct. It's not way high compared to others in the industry. And then, they're not, the stock price isn't so high or so through the roof like the nifty 7 or 8, like Tesla and Google and Amazon and Microsoft. They have such high stock prices currently that I don't see them as bargains. I see them as great companies, and they meet a lot of the criteria I just talked about, but they're too pricey at this point. I do think they potentially will come down, probably maybe this next year. I don't think they can continue to grow like they did. There's been a lot of comparisons like NVIDIA is another one. Comparisons of what Cisco used to look like, I think right around 2000, 2002, 2003, it got way up there value wise. And it since then it's dropped off and still has not gotten anywhere near the high prices it had back in the early 2000s. Could that happen to NVIDIA? Well, it could. So that's why I'm trying to look for companies that aren't, they aren't overpriced. They're what I consider bargains. And not necessarily like they're cheap, but they're just a good value. They're not overpriced or overbought. Maybe they're oversold because of some projections that didn't make sense. And I see that a lot with Zoom. I notice they sometimes will have kind of bad projections, but then overperform. And then what I like to do is I like to use the option wheel. And typically with the option wheel, recently I've been taking more risk, mainly because a lot of my positions have not been assigned to me. When I'm running the wheel, a lot of times I do want the positions to be assigned. So I was using more like a 15 delta, but now I've increased that especially for these companies that are bargains, I'm going more like a 30 to 35 delta when I sell the puts on them. And if you're not familiar with the wheel, you first sell a put, so someone pays you for the ability to sell you some stock. So you'd sell a put and you take a little bit more risk with it, and you bring in a little bit more cash than you would have. And then hopefully it gets assigned to you. And at that point, you own the shares. Again, each contract is like 100 shares. I typically do 2 contracts, so that'd be 200 shares. And at that point, I'd sell a covered call, again, fairly close to the money, taking a little bit more risk, so maybe 30 or 35 delta for even selling the call. And this is especially true if it's in a retirement account where I'm not taxed on it. So again, the goal being, that it would get assigned away from me. So suddenly I'm back with the cash that I started with, and then all the different premium. And typically when I, sell these, each strike is going to be a slight improvement, maybe not a major improvement, but in a short period of time, you'll make some pretty good money. And then you can literally run the wheel again. You can then sell another put, have the shares assigned to you, sell another call, have the shares assigned away from you, and so on and so on. And you can bring in some really good cash. Now, one thing I typically do that I do get a lot of questions from my members is why do I, sometimes why do I use vertical put credit spreads versus cash secured puts? Now, when I'm running a cash secured put, if I can buy a put cheap, either at the $5 or $10, spread, meaning it's like $5 out or $10 out. So if it's like a $40 stock, can I buy a $30 for the put, or say a 35? And for a call, sometimes I'll also do that for a call. Maybe if I can buy the call cheap, I'll look at doing that. To me, it just makes sense. And we'll talk a little bit more about that at the end of the video. But a lot of times I will, even though I'm running the wheel, I will purchase a put or purchase a call if it makes sense. And typically it makes sense to me if it's relatively cheap, less than a cup of coffee. It kind of really makes sense to do it if it's that cheap. And then finally, one thing I do like to do is manage my trades. So each week I will typically look at any trades that are expiring over the coming weeks. And I'm going to actually share with you my planning worksheet and the trades that I did on the stocks I was talking about, the 2 stocks, and I'm trading a lot this week. But I put anything that's expiring over the coming weeks in that spreadsheet, and I actively manage them. That way, even though I have 80 or 90 positions that are open at any one time, actually, I think I probably have around 75 at this time, it allows me to manage what's most important. And then in that planning worksheet, I also keep all the details, the guidelines, and other key important things that I need to kind of keep track of and, sometimes look back at. So, and I typically share each of these planning worksheets with my memberships. And as always, if you're curious about my memberships, you can find more down below. I have two basic memberships. One's a $10 membership where you get access to my trades. I actually post quite a bit. It's more like a true post. I talk a little bit more about why I make the trade. Then a lot of my members will question me, why did you do this? Why did you do that? Why didn't, you take less risk, or why did you take more risk? And I typically address that. So it ends up being a nice dialogue. And then for the more expensive membership, which is $25 a month, I actually provide a weekly coaching session. So if you're new and you need help getting started, I do a lot of hand holding. Or if you're just a seasoned trader and just want someone to talk to and work through your trades and things you might be missing, I also have a lot of seasoned traders too. So I encourage you, take a look. Details again will be below. And as always, please hit that like button and subscribe. So that's it. That's primarily what I wanted to talk about. The next part of the video, I'll actually go into my planning worksheet and I'll share with you these two companies that I've been trading in recently. So let's jump into the next part. Now, the first company that I want to talk about today is Block or Square. This is a company I've been trading in for the last, I guess, 3 or 4 months. It kind of took a dive after they had some network issues, but recently they've kind of bounced back majorly. And they have some amazing growth potential. I'm actually looking at using them for credit card processing for my son's business. And I like their product line. I like how they do things. And they really have some amazing year-over-year growth. I'm going to show that to you here in a minute. But here you can see they really took a dive and now they've recovered quite a bit. I'm at 1 day. Let's not look at that. But you can see how I think they got to as low as 38, and now they've come all the way back up, and they're closer to their 52-week high, but they do bounce around a bit. I rolled a trade, and we'll talk about that in a minute here, but they have really good premium, probably some of the best premium I've seen out there, so I typically have been able to roll. I currently do own a couple hundred shares, and I've been selling covered calls on them and been able to roll pretty nicely up and out and pick up some nice premium. But you can see they've beaten earnings most of the year. They missed, I think, first quarter. But they typically have beaten their projections by a fair amount. So in the last quarter, 55 versus 47 cents. And then if you come down, they've got a pretty good handle on debt. They decreased back from 21. They are a bit higher than they were in 2020, but they've really done a nice job managing the debt and keeping it to a minimum. Now, if you look at what I like to look at, I like Square and how it shows more details and some information that you can't find anywhere else. If you're curious about, I am an affiliate of theirs. So if you're interested in joining Seeking Alpha, there is a special. If you again look in my description, I do get a little bit of a kickback, but it's typically the same price for you if you order it directly from them or go through my link. But I use it. I pay for it every year. I literally just paid for it again. And I like how they, will give you SA analyst ratings. They'll give you Wall Street ratings. And you can see nice articles here that you can read through. And so with Square, they're doing well. Numerous tailwinds will drive impressive returns. I really like their product line, and for a small business, you can get started fairly inexpensive. You do have to buy the hardware, but they're fairly reasonable especially compared to the banks. The part of Seeking Alpha that I like to use is the year over year, so you can see the crazy year over year projections they're having. And like I said in the past, they typically beat these projections by a fair amount. So, you can see 160, potentially 160%, 64%, 89%, 69%. And they typically have really, like I said before, typically have really good premium, both for puts and call options. So I potentially see them as a much bigger company in a couple of years. It could be, I don't know if it'll be anything like an Apple story, but I could see them very easily, being over $100 at some point next year. They've back in 21, they were way up. I think they were over 267. But I could see them getting over 100. I would not be surprised at all. Now, the other company I wanted to talk about was Palantir. And I've had a lot of members asking me about Palantir for probably going back 6 months. I've recently decided that I like them mainly because they're making money now. And they potentially, just like Block or Square, they also have potential for some really good growth. Now, the PE is still pretty high because their current earnings, I believe, is around 25 cents. So, but like Block, they also have majorly beaten their earnings pretty much all year. And what I really like about them, if we come down here, is they have no debt. They used to have almost 400 million in debt back in 2019, and now they've paid it completely off. So to me, that's amazing. Any of these companies that can be growing like these two that don't have any debt is truly amazing to me. I mean, so let's actually jump in here and we'll look at Palantir and we'll look at earnings. And here you can see they also have some really good projections year over year, 89, 39, 41, almost 9%. And, if they beat these projections, I would not be surprised to see them making 50 cents next year, maybe 60 cents if they do really well, which would get them in line with their PE would be considered pretty normal. Right now, I believe their PE is, I think it's a little bit, might be easier to see it over here. Yeah, it's like 69 because it's based on 25 cents. So that would be half that. It would be like a 30 PE. So, with that kind of growth, I could see them, that PE being more like 25 or 30 sometime next year. And they could be a lot like Zoom. Zoom also has no debt and they have a really low PE and quite a bit of premium too. Another good company to look at if you're looking for, something else to trade. So I recently have just started trading with them again. It's if you look at growth, A plus for growth. I think the same thing with Square, yeah, A plus for growth. So that's the main analysis I like to look at. Again, year over year earnings, debt. Neither one pays dividends, so you really can't look at that. But the fact that they're well run and they have a firm handle on debt is really, really important. So let's jump into my actual trades. So this is the planning worksheet that I share with my membership each week. I typically will send it out on a Sunday night. And at the top, I just, I share the dates. I share what some of the different meanings are. I also share my weekly and monthly goals. And this is kind of the pie in the sky. I've been able to reach it most months, but I try for around 1,600 weekly and 6,400 monthly. And this is between a number of different accounts, including my Fidelity IRA, which I just started. I moved my 401k to an IRA back in October. So about 600 of that on a weekly basis is related to that account. So it used to be 1,000 and it used to be 4,000 monthly. This month so far, I've done 5137 and I have one more week, tomorrow and one more week. So I should get pretty close to that. So at the top of this spreadsheet, I've got the companies that I'm suggesting for the week. You can see here's Palantir, here's Zoom, Cisco. I feel like Cisco's oversold, and then eBay. And eBay, I think, has recovered quite a bit. It might be as high as 44, 45, might even be as high as 47. So I just share this each week. I don't necessarily trade in these. A lot of times I may only trade in one or two. because I do a lot of different types of trades. I do covered calls as well as cash secured puts and vertical put credit spreads. Now, I'm not going to go into each and every one of these trades. I just primarily wanted to show these two. Here is Square, and I actually rolled it. It was a 60, so it's a cash secured put, and I rolled it. It was 74.20 at the time, and I rolled it to 65, so still very far out of the money. And I believe it's still quite a low delta. But I rolled it to 216.24, and I brought in 271 in premium. And I believe the previous trade, which was just literally a month ago, I brought in over 400 or right around 400. And on a yearly basis, this is almost like a 13% return. And the reason that's higher than some of my other returns is, again, this is a cash secured put. So it's using two contracts, 12,728, which is the 6,500 times 200 minus the premium that I just brought in. And you can see that in the equation up here. So again, really good premium. And it was, what was the date? It was 12/18 when I made that trade, and I just rolled it from 119 to 216. So I didn't roll it very far either. And now since I've done that, I believe it's gone up another $3 or $4. So this trade is also already very profitable. I'm not going to talk about Corning. I did do some covered calls with Corning. I'm going to talk about Palantir here. So this is a new vertical put credit spread. And the reason it's not a cash secured put is, again, I purchased the put. It was only $1 to purchase. So to me, it made no sense not to do it. It was a 16.6. So the $6 put was so cheap. It just made sense to buy it. Now, after I made the trade, I thought, well, maybe I should have done $9 or $10, because I think you could do up to $9 or $10, and it was only maybe $4 or $5 to purchase each put contract. This was a 30 delta. Again, I'm taking a little bit more risk with these because I really want to own them. The expiration was 2/16, so I think it was like 58 days DTEs. The current price was $17.53. I do believe it went down quite a bit yesterday, but was back up today. And I brought in $373. It was 4 contracts, so since the strike was 16, being fairly inexpensive, I did more contracts than I typically do. I typically only do 2, but since this is such an inexpensive stock, I did 4, and that's why it was a little bit higher. And since it's a vertical put credit spread, I don't need as much cash for it. So it was the 4,000 minus the 374 or 373 is how I came up with the 3,626. It's the required capital. And it's like almost a 65% return in a very short period of time. So a really good trade. And my guess is I may be able to close it early too, which again just causes the return to go up considerably. Now, the other 2 trades were covered calls. With the market being up so much, I've done a lot of covered calls recently. One is Franklin Resources that I did yesterday, and then earlier today I did a Truist covered call. For this one, I took a little bit more risk. I got a little, I don't know, I decided I could have done 42.50, but I stuck with 40, which is almost a 35 delta, which is higher than most of my calls, but the next higher strike was 42.50, and I think I'd brought in half the amount of premium, so I thought it was worth the risk. The chance is if it gets called away, I believe I'm profitable at this point, but I should be able to roll up and out. I don't think it's going to move that much, and I don't think the regional banks are out of harm's way yet. I think if we do get a pullback late January, early February, I think it may come back into the low 30s. Right now, I believe it's like $36 or $37, and for that, I brought in 277, so that was a little bit higher. I believe it would have been 170 or 160 if I had done the 42.50 strike versus the 40. And this, again, is just my cost basis for those shares. and it's 6.56% return. So I was able to double the dividends here. You noticed I mentioned doubling the dividends, and that's another key thing that I typically try to do is I try to double the dividends. Now here I also have other stuff that I provide. So I've got a checklist, I've got guidelines, I've got goals, and other information that might need to be stored. And this again all comes. I provide it each week to my memberships, and they can use it as they need to, and they can change things. But the goal is for them to put their own trades in here. So I just wanted to share that these were the main trades that I made. The two companies that are somewhat new trades. I've been trading with Square for a while, but Palantir, this was first trade I've done with Palantir. So thanks for joining me. As always, if you have any comments, concerns, please leave a comment below. I typically will answer all my comments. And usually within an hour or two, worst case scenario, maybe the next day. So thanks for joining me, and I hope you have a wonderful holiday.